Investment advisory services offered through SWAN-Capital Management, LLC, a SEC-registered investment advisor. SWAN-Capital Management, LLC, and SWAN-Capital are independent entities.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say, where we take financial chickens and we make them financial swans. I'm your host, Andrew McNair. And at What Your Money Would Say, we believe in SWAN. We believe in what it stands for. Sleep well at night. And as a retiree, you deserve to sleep well at night. You know, you've worked your entire life saving in your 401k plan. You've been giving to your church and your charity. You've put kids through college. It's time that you finally sleep well at night as a retiree. And we're going to talk about instruments where you can save in retirement, where you can feel confident in retirement, that you can sleep well at night. Now, this is a part of a two-part series where we're talking about qualified plans. So stay tuned in. But before that, I want to share with you an upcoming event we have here at the SWAN-Capital community. We have a couple veteran aid and attendance workshops that my nonprofit, the Veteran Benefit Project, puts on. We're going to teach families on how they can apply for up to $24,000 a year, tax-free, from the VA. We're going to learn how you can get these funds to help pay for assisted living, nursing home, and caregiving services at your parents' house, at your house. And these benefits have been substantial for hundreds of families that we've helped get these benefits for, so that you no longer have to worry about how are you going to pay those large bills. So you don't want to miss those classes. You can check out SWAN-Capital.com. That's SWAN-Capital, like the bird, and check out our upcoming events page to check out the upcoming events we have. Now, while you're there, sign up for our weekly market update so you can stay abreast of what's going on in the market, and like us on Facebook and follow us on Twitter. Now, on What Your Money Would Say, this is a live show. And the phone number, if you want to call in with your question, we're going to talk about some very intriguing topics today. So if you have your questions, call 478-3116. That's 478-3116. And we'll be happy to answer your question live on the air. If you have any other questions, always drop us a line at our SWAN-Capital.com website, and we can answer that on the air next week. Now, last week we talked about IRAs, individual retirement accounts, and I wasn't too nice to them. I beat them up like a piñata last week, but I didn't give you many alternatives on where else can you invest, or if you're trying to exit your IRA, where do you place your funds? Where do you put your hard-earned dollars? And that's what we're going to do all today. We're going to talk about your options. And I want to start off with the fundamental questions that we asked last week, and that is, what have you done to reduce your federal income tax? I'll repeat the question again. What have you done to reduce your federal income tax? And that's just a huge question. I know that many families have CPAs, which is a great trusted advisor to have on your team. They deal with lowering your federal income tax and your state income tax if you're in a state that has it. But that is a year-to-year decision. As a wealth manager and a financial advisor, my job for my clients is not only lowering their federal income tax every year, but lowering it over a lifetime. And that is something that requires forethought and planning. So what have we done to reduce your federal income tax? And we're going to talk about some tax-free options today that can allow you to do that over a lifetime. So stay tuned in. The next thing is, what plans have you done to create tax-free income? Now, this is such an important question because it seems like we live in a Robin Hood society, or a Robin Hood mentality, and we think that we can just take from the rich and redistribute their wealth to the poor. And it seems like the government's trying to do a better and better job every year of doing that. So how do you protect yourself? You know, you remember, I'm dedicated to helping retirees sleep well at night. And as a retiree, you shouldn't worry about what's going up at Washington. Are they going to raise taxes? Are they not going to raise taxes? In retirement, it's about being secure. It's about feeling good about your financial future. And, you know, lowering your federal income tax and creating tax-free income makes financial sense. But we also need to make emotional sense, too. we need to take away some of those question marks of what is my retirement income going to look like in the future. And the way to do that is create tax-free income. So as you're listening to the show, I'm going to encourage you ways to kind of step out of the box and look at ways where you can create tax-free income, because that's the focus of today, tax-free income. And we're going to try to encourage you to challenge the status quo. You know, I read all the time in the same financial publications, Money Magazine, Forbes, about how you should invest and continue investing, max contributing to your IRA, your individual retirement account. And that's great advice. But the problem is it's been the same advice for the last 30 or 40 years when they've been created. And it might be a chance that advice is grown stale. It's grown rotten. So my job is to help you realize that really IRAs are tax-infested investments. And in retirement, we don't want tax-invested investments. We want security. We want to know what our tax bill is going to be when we get to retirement or as we go through retirement. So we're going to talk about those options. And if we look back, like I explained last week, is IRAs were at one time a really good investment. But every investment can go from being a good investment to a bad investment, and then go from a bad investment to a good investment. Right now, IRAs, I feel, are a horrible investment. Back in 1970s, when they were invented, the top marginal tax bracket was over 70%. It made sense to stick your money in an account and tax defer it, hoping that taxes got lower. For the families that did in the 70s, it worked. But in today's environment where we're in 30 and 40% tax brackets, doesn't make sense to defer taxes. It may not anymore. Also, I talked about the limitations that you have with your IRAs. And we're going to talk about its cousin, the Roth IRA. The Roth IRA doesn't have a lot of these limitations. Like with a traditional IRA, at 59.5, you can get stuck with some severe penalties if you take out money before you're 59.5. And I struggle with that. You know, just because you're a financial advisor and a wealth manager doesn't mean I get a pass at financial decisions. I have to make the same financial decisions that you have to make. I don't invest $1 in IRAs because of this one point. If I wanted to go invest in, let's say, real estate, and I see that real estate is going to start booming, which it may do in the next 5 years. If I'm in my 30s and 40s, I can't just take a distribution from my IRA and then go invest in a great opportunity. No, I get stuck with a 10% penalty and have to pay the taxes on top of it. So that's where I get very disgusted with IRAs. And if you're saying, well, Andrew, I'm already in an IRA, what do I do? We're going to talk about that. It's not too late to finally take action on any investment. The next thing I didn't like is age 70. At age 70 and a half, you're going to have to take a distribution. You're going to have to take what we call our required minimum distribution, your RMDs. And if you don't, they hit you with a 50% penalty on your money. So let's say you have to take out $5,000 the first year. If you don't take out that $5,000, the government hits you with a $2,500 penalty. That's absurd. That's your money, plus pay the taxes. I just think it's just a disgusting investment, how it was created, just too many restrictions. Also, contribution limits. You know, in my field, owning a business, you can have good years and you can have bad years. And in a really good year, let's say that I want to put a lot of money into my IRA. Well, they say, nope, you can't stick all that money in there. You can only stick this amount. I don't like limitations, and I don't think you do either. So if you're looking at your IRA statement, if you're looking at contributing to an IRA, I just want to kind of put the brakes on there. You know, if you have a 401k and they match, you want to continue doing that. But anything above, I want you to look at these tax-free options that we're going to go into really great detail. And I want to solidify, again, why change is necessary. Let's face it, change can be very difficult. But I want to show you that sometimes not making a decision can be just as bad as making a bad decision. So let me give you an analogy. If you were a farmer and you were going to buy seed for your farmland, and you went to the seed store, and the attendant says, "Hey, we got two options, A and B. In option A, you can pay the taxes now on your seed, and we'll let you take your seed and go harvest it, and since you've already paid the taxes, that harvest is all yours." You say, well, that sounds good. I won't have as much seed initially, but I like that harvest is mine. Or the tenant says, oh, but wait, we have this really neat option B, where you don't have to pay any taxes now, which everyone says, oh, I like that, sigh of relief. I don't have to pay taxes now. That sounds like a deduction, but it's really a deferral. And they say, well, I won't pay my seed now, but however, when you finally do harvest your crop, me and a couple guys are going to come out to your harvest, and we're going to tell you at that point what your fee to us is for taxes. So we can't promise you what it is going to be now, but it might be higher. But which one would you want to go with, A or B? You'd say, that's absurd. Who would ever go with B? However, millions of people are investing in IRAs, because that's not their expertise is not financial decisions. That's what they leave up to their advisor. And sometimes their advisor gets the same training that 1,000 other advisors got. So I want to challenge some of these status quo ideas that we have about investing. And if you have questions about your situation, give us a call, 478-3116. That's 478-3116. And we'll be happy to answer your question live on the air. So if you're saying, Andrew, that sounds like me. I need to get my harvest now. I'll pay the taxes, but I want to get out of this thing. I want to look for the exit. Where do I go? These are the 3 tax-free options that we're going to dive deep into today. We're going to talk about municipal bonds. We're also going to talk about Roth IRAs, the cousin to the IRA, the better-looking one. And then we're going to talk about life insurance. Those are your 3 tax-free options. There's some others but they have a lot more limitations, and it can get a lot more confusing. The 3 main that I focus and I share with clients are municipal bonds, Roth IRAs, and life insurance. Let's start with the first one. What is a municipal bond? Basically, a bond is what we call a debenture. It's a loan, typically with a government agency, a government institution that says, hey, we need some money to build this bridge. We need money to build this huge building. And this isn't surprising to you. The government doesn't have the money. So they say, we need to take a loan from you, the taxpayer. So you say, that's fine. You agree on some terms. You agree on what's the payback. You agree on what's the interest available. And you hand over your money. And they take all these municipal bonds, all these loans, tiny loans, and then they go buy a bridge or a building. And the great thing about this is the government cuts you some slack. They say, hey, thanks for helping us out. We'll cut you some slack on tax time. So that's why municipal bonds get some tax-free help. Now, you might know of a municipal bond. We have one right here in town. The Garcent Point Bridge was a municipal bond. However, if you know anything about in 2011, 2010, it ran into some huge financial problems. Not only does not many people cross it, the toll is just so high that it just makes more and more people not want to go over it. However, who was left holding the bag was the bondholder, the municipal bondholders that maybe were told that it was a secure investment, that they needed this bridge to get to this other part of town. And these people could have bought this all over the country and not known that no one's going to go over that bridge if you raise those tolls like they do today. So here are some of the pros about municipal bonds. You have to be enthusiastic about the pros as the cons. That's my goal when detailing any investment to you. The first is it's tax-free, which is really nice. Now, if you lived in a state that had state income taxes, some municipal bonds could get stuck with the state tax, but typically most municipal bonds are considered tax-free. So that's a huge, great benefit of municipal bonds. Again, there's only 3 avenues we have for tax-free. The next is the growth in income. You can focus more on a growth municipal bond that's going to appreciate, or you could focus on the income that it's going to pay to you. A lot of this, it can give some really tax-free income in retirement. You remember, back to the original question, what plans have you made to create tax-free income? It's nice when you have maybe $100,000 in municipal bonds earning 5% tax-free. I think I can do the math on that we're going to get about $5,000 in tax-free income. That's a pretty good day. It's a pretty good year. We don't have to worry about, well, what's my tax rate this year? So those are the pros. Also, I almost left out diversification. You can diversify through a municipal bond fund. See, many families that just invested into the Garcent Point Bridge maybe did not invest over many bonds. So they might have just bought that one bond. So that could get stuck. So always focus on the diversification. The cons. Now, we've talked about this a lot on What Your Money Would Say. If you're just tuning in, this is What Your Money Would Say, and we're talking about tax-free options. You're just coming into the first investment we're talking about, which is new municipal bonds. The first con about municipal bonds are the bond market. Right now, we are in historic low interest rate environment, and it seems like they're continuing to suppress these interest rates. However, those artificial suppressions can have lots of consequences down the road. If we continue to push a spring down and continually push it down, we're going to have tension, and eventually that spring is going to want to go north. And if it does, it can cause a lot of havoc in the bond market. Because if interest rates go up, bond prices go down. They have what we call an inverse relationship. So if we're at a historic low, I mean, practically they're just giving money away. And the bond, I mean, we're talking 2 and 3%, bonds out there. It can be, when that comes back, when it bounces back, those bond prices, bondholders only have two choices. They can hold the bond to maturity, which we're talking 10 to 30 years. Most of you may be saying, well, I'm not even be around in 10 or 30 years. So that's not, option A doesn't work for me. Or option B, we have to sell those bonds at a loss. And that's breaking the rule of investing. Don't lose money. So we don't want option A or B, really. So you got to be very suspicious of the bond market and be very careful. The next is Pacific risk. Back to the Garsoint Point Bridge. If you put all your money in a bridge in California, and they're known to go bankrupt in a lot of situations, it could be scary, because if you have all your money in one bridge and the toll doesn't generate the money it was supposed to, or it was never completed, or it ran over budget, that could hit your bottom line and not give you the income that you thought you were going to get. So that's the great benefit of municipal bonds. The next one we're going to talk about is the better option of IRAs, the cousin of IRAs. And we got a lot of talk about this. It's the Roth IRA. So in just a few minutes, we're going to break down the Roth IRA for you.
What Your Money Would Say. Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at SWAN-Capital is dedicated to providing the very best service in the retirement planning industry today. SWAN-Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. The difference between SWAN-Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. SWAN-Capital. Sleep well at night. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. Again, that's 850-380-9558.
The Veteran Benefit Project, founded by Andrew McNair, president of SWAN-Capital, is a nonprofit organization dedicated to helping veterans and widows of veterans with long-term care expenses by qualifying for the VA's Aid and Attendance Benefit. Learn how to receive over $24,000 per year from the VA towards long-term health care. There is absolutely no fee associated with our assistance to the veteran, the widow of a veteran, their families, or any retirement community. Our goal is to preserve the dignity of the veteran and to reduce the dependency on the Medicaid system. Again, learn how to receive over $24,000 per year from the VA. Contact the Veteran Benefit Project 850-380-5137. That's 850-380-5137. 850-380-5137. Look us up on the web, veteranbenefitproject.com. At the Veteran Benefit Project, we are committed to helping you secure the benefits you deserve.
Retirement expert Andrew McNair. Changing the retirement paradigm. Now back to What Your Money Would Say. Brought to you by SWAN-Capital.
Welcome back to What Your Money Would Say, where we take financial chickens and making them financial swans. Now, if you're just tuning in, we're talking about tax-free investments. And if you have any questions about tax-free investments, feel free to call at 478-3116. That's 478-3116. We're live here on Saturday. So if you feel like you're kind of scared to give out your name, make up a name and call. So we're talking about the tax-free investments. You know, we beat up IRAs. We talked about all the limitations, all the frustrations of we have no idea what tax rates are going to be in the future. And we're kind of listing out and talking about the pros and cons of the 3 tax-free investments that are available to you. And we're talking about municipal bonds, Roth IRAs, and life insurance. Now, municipal bonds, as we talked about, the pros are you can get some tax-free income from it. And that tax-free income can be quite substantial, can be greater than what CDs are paying, plus they're taxable, which is great. We don't have to pay taxes every year. But the cons are we got to be worried about risk. You know, most of the time families think bonds are not susceptible to risk. We found out in 2008, stocks and bonds can go down at the same time. And in this low interest rate environment, investors need to be worried about what's going to happen with interest rates. If it spikes and jumps back very quickly, that can mean a lot of losses in the bond market. So we got to be worried that we don't run into a bond market bubble. The next one I'm going to talk about is Roth IRAs. Now, Roth IRAs were a huge thing in about 2010 when they took off the limit restriction. What that did is that flooded the financial press with, hey, convert now, convert to your Roth. But a lot of times after that all went away, all the smoke cleared on taking up the income limit on Roth IRAs, people just stopped talking about it. But Roth IRAs are just such a better looking cousin than the traditional Roth IRA. And here's why. First and foremost, it's tax free. Back to the farmer analogy. You're paying the tax on the seed now so that all that harvest is yours. You don't have to worry about Uncle Sam, who, by the way, is not your uncle, not blood, and he always tries to tax his nephews. So you don't have to worry about him anymore. The second is tax-deferred growth. In IRAs, I do like this about traditional IRAs. IRAs have tax deferral. In and of itself, tax deferral by itself is a great thing. If you're constantly, having to pay taxes on your CD every year, that's what we say that's financially inefficient, because you could be growing that tax deferred and having some of that work for you instead of paying the tax man every year. So that's the first two. We have tax-free in the Roth IRA, and it's tax-deferred. The last is what I don't like. What I didn't like with the traditional IRA is all the handcuffs. You got all these handcuffs, and they practically hold your money hostage in a traditional IRA. And what's nice is you have the option to convert your IRA to a Roth IRA. And we've helped families do that, where we can take your held hostage money and we can move it over to a Roth IRA, pay the taxes now, pay it now in a low interest rate environment, eliminate the worry of what the people, the political bureaucrats are going to do upstairs in Washington, eliminate the risk of them pinheads doing some crazy things, and making sure that your nest egg is protected. Again, the fundamental questions that I help my clients do is, what plans have you done to create tax-free income? Through municipal bonds and Roth IRAs, we can do that without having the limitations that we have in the IRA. The next thing I want to talk about is life insurance. So we know the pros and cons of Roth IRA. Let's move on to another one that most families kind of push off the table and they don't think about, and that's life insurance. Whole life insurance has tax-free components to it. Now, I want to put aside the death benefit side, because we're not talking about dying today. We're not talking about estate planning as much. We're talking about growing your hard-earned dollars. And we want to grow it tax-free, and we want to grow it efficiently. The pros of life insurance is we can do some of the great things that we could in the Roth IRA, and I'll share with you some added benefits that the Roth doesn't have. The first one is we get tax-free growth. Inside whole life contracts are what we call a cash value bucket. That cash value bucket can grow to 3 to 5% tax-free, and those funds inside that cash value can be used throughout your life. You don't have to wait till you die to access the cash values. You can either take a loan on that money and I'll talk about why you would want to do that. Or you can take out the money. That is your money. You don't have to wait till you die to actually collect on your life insurance. The next thing is that money grows tax deferred. Now, in and of itself, tax deferral is great, especially if it's continuing to grow tax free. Also, the thing I like about life insurance is the guarantees. With Roth IRAs, municipal bonds, we pose a lot of risk, specific risk, investing in the wrong investments and them not turning out right. At least life insurance has components of guarantees. Not all of it's guaranteed, but a lot of it is. Also, what I like is the no limitations part of life insurance. I can put money in, I can put money out, and I don't have to worry about restrictions of 59.5 rules or contribution limits. Let's say in my business I have a really good year. 2013 has been a good year. I can max fund that life insurance policy, and some years I don't have to max fund it. So that's a great thing. The next thing is what I put aside initially, I can bring it back now, is death benefits. Let's say we can't plan our deaths. Let's face it. If we passed away in 2008, which people did, and you have your money in a Roth IRA, a traditional IRA, let's say your account was $200,000 and now it's $100,000. Do you want your spouse to get the original $200,000 you had before, or do you want her to get the $100,000? Well, he said, of course, Andrew, I want my wife to get the $200,000. Well, if that's the case, you can't do that. You can't guarantee that with a Roth or a traditional IRA, because let's say I pass away and my spouse, I'd pass away in an opportune time, like a stock market crash. My wife will get either the choice of the cash value or the death benefit. So if the cash value is 100 and the death benefit's 200,000, she's going to take the greater of the two, and she's not going to worry about the stock market worries, and which is such a terrible thing, to not only be down financially but lose a loved one, which can happen. Also, that death benefit can unlock other benefits. We've been able to help military officers when they get to retirement time. Do you take survivor benefit or don't take it? Well, if we have a large amount of life insurance, we can take the single life and know that our spouse is going to be taken care of. The cons are, you got to make sure that you're dealing with the right kind of company. You don't want to invest with a B-rated or C-rated company. You got to watch out that some have high costs, but again, guarantees cost money. You can't not have guarantees and not cost any money. And you have to make it structured right. You can't just buy the run-of-the-mill life insurance and hope that it works out. So we talked about three main tax-free options: municipal bonds, Roth IRAs, and life insurance. Like I was telling you before, there's bad investments at some times, and they turn into good investments other times. And sometimes a good investment is not a good investment for you. It could be a bad investment. There's no cookie-cutter investment for anyone. You have to look at every situation, and you have to work with an experienced advisor that has a specialty in conservation and distribution. When we get to retirement, it's not so much about the accumulation. It's about just making sure that you get what you put in there. And so many people understand that. In 2008, most families would have just been happy to come out ahead and not lose their life savings, not wait 5 years to retire. If that's you and you want to learn more about tax-free options, I encourage you to call SWAN-Capital at 380-9558. That's 380-9558. And please check us out on the website at swan-capital.com and drop us a question, and we'll be happy to answer it live on the air next week. I hope you have a wonderful week, and I'll see you next time on What Your Money Would Say.